the Friday before Labor Day.
It
So
is. Everyone is enjoying their weekend. Everyone
this
is.
jobs report has always come out at inconvenient times, but it is what it
They
is.
do. We'll do a live session in the morning. We'll do it when everyone's just waking up. We'll do a breakfast session.
We will. Actually, that might be a great idea. Um, and so
A
with that
jobs report
said,
reaction video, so to speak.
yeah,
Oh, disappointment. Oh,
I do think that we should do a video where we get up at 5:30 Pacific
that's
for the
right.
8:30 launch, and we go live at 8:25, and
That's right.
then we react to the report as it comes out.
Look at this,
Um,
Albert. Can you believe it? What a disappointing jobs report.
exactly,
How did this happen?
exactly.
That's great. I'll be too tired to function actively, but I support the idea. This is great.
I support it too. So everybody, happy Friday. Welcome to our monthly jobs report readout and economic deep dive with Dr. Riley White of the University of New Mexico. Dr. White is the Associate Professor of Finance and Endowed Bank of America Lecturer at the University of New Mexico. And in addition, he teaches MBA students and serves as a University Outreach Chair for the CFA Society of New Mexico, Chair of the Cassidy CFA Scholarship, and an advisor for the 3.6 million student-run University of New Mexico Regents portfolio. Prior to his career in academia, Dr. White worked as an analyst for a large Boston bank, where he learned a great deal about company analysis, funding, and maintaining ethical corporate leadership. He's here today to talk about the latest jobs report, which showed that we had 235,000 jobs added. And even though that's a discouraging number, unemployment rate fell to 5.2%. And, analysts has expected 720,000 jobs added, but, we suspect that the Delta variant has made that dent. And we're going to talk about all of that today. And that's our deep dive. We're going to talk about how this latest variant has affected the economy, other variants to be wary of. I've been reading about the Mu variant, which is apparently the next greatest thing that we're going to have come through for us, and how to really play things for the next few months. We're into the fall season here. The holidays, Christmas is 3 months and 22 days away, but nobody's counting. And, I really just want to see where this all goes. So welcome back, Dr. White. Thanks for joining us, and I'm looking forward to hearing your insights.
Oh, thank you so much, Albert, and thank you so much for our attendees today on this Friday before Labor Day weekend, making it out here and having a little talk about the jobs report. I'm so honored. I want to remind you, as Albert pointed out, if you have any questions about anything, whether I'm going over a slide or anything else, you can always ask them in the open question portion on the Q&A or within the chat window, whatever you can see. And whatever works best for you, I will answer them either anonymously or with your permission, and I'd love to get into more details about stuff. So anyway, we are in it, and I'm going to share my screen right here to show you a little bit of what's going on in our August 2021 jobs report. Let me, oh, there we go, should come across here. I'll have both windows open so I can do this thing. I'm going to do this thing where, just because of my giant and oddly shaped screen, I'm going to keep this in non-presentation mode so you can hopefully see it better and it appears a little bit bigger as we go through this information. So again, my name is Dr. Riley White. I'm an assistant dean at the University of New Mexico, as well as an associate professor of finance. We always follow jobs reports. We always follow the discussion. So I touched upon a couple of what I'm doing in this lecture today is we're going to go over some of the big overview questions that we have around the jobs report, break it down by sector, look at the effects of COVID, and then we're going to go into the Bay Area a little bit deeper, and then we're going to look at some parts of the economy that this is hitting particularly hard. And we're thinking back to the parts that were hit hard before. So think travel and leisure, think dining, think air travel. And again, also think of something. I also do a little feature down at the bottom. We're going to talk a little bit about the price of rents and why the COVID dynamic involving that. We talked a little bit about housing last time. This becomes very important, especially as we go over the next few months. And hopefully all the other Greek letter variants of this virus that we hopefully will not get, but are still coming our way, will be remedied and realized. So anyway, let's talk about our August 2021 jobs report. So if I were to summarize this is a great disappointment. And that's also the name of my autobiography. So we have 235,000 new jobs. Unemployment fell to 5.2%, but before we get excited about unemployment, we know, of course, from previous lectures and anything else that looking at the U3 number, looking at unemployment levels is not sufficient. This is not good, but there's a few reasons why this is. The first is seasonal. We had a whole benefit of hiring, a group of hiring that were in educational services this summer in preparation for the start of the semester. Most of those were completed by August. And so those have completely dropped off the map for major hiring areas. Where we did see jobs, and Albert pointed this out in the Facebook post today, we saw about 74,000 jobs in professional and business services. Now, this is a very overarching term, so I broke it down a little bit more specifically. The good news is where we've seen these jobs that have been added to the system, they're in areas that are high paying and they're very interesting scientific occupations. So for instance, about 19,000 went into architectural engineering services. That bodes moderately well. That's a good thing to look at because we're looking at firms, especially in areas where they're expanding, building, and needing the services of architects and engineers. This is a good sign going forward because it shows that they are more confident about producing and getting work done. 10,000 in computer systems design, 7,000 in scientific research. Those aren't crazily high numbers, but the good news is if we go dive down a little bit into the Bay Area, we know that those jobs pull a lot of money and pull a lot of weight, and they're incredibly important. 53,000 in transportation, 40,000 in private education. Interestingly enough, private education saw a bump. We saw a drop off everywhere else. We haven't seen government hiring increase in any real way, and I'll kind of drill down into why that might be. Also, we have about 37,000 additional manufacturing jobs, and these have been floating back and forth. On one hand, we're struggling with this question of American manufacturing relative to other countries. Right now, the sort of collapse, not collapse per se, but that is a hyperbolic statement. But we've seen COVID creates issues with supply chains. The reason that we have, say, a silicon chip shortage, which is phenomenal, is because the greatest number of silicon chip factories in the world are located in Southeast Asia, which is being ravaged by coronavirus. And so consequently, they're causing factory closures and consequently supply issues, which supply everything in the things that we do are expected to continue through 2022 and 2023. That means we have to look for solutions, and the solutions would be domestic. We're seeing a little bit of recovery here. 37,000 manufacturing is better than I thought manufacturing would be this month, but it's not it's not something it's not something to rest your hat on right now. Now, wage growth. Now, we talked about one thing. We drilled down into what drives inflation. To keep inflation sustained over a long period of time, you need growth in wages. And we know that we've seen growth in wages. We have anecdotal evidence to suggest that firms are paying more. And we've seen through the last 6 months, and I've reported this number always on each one of these, wage growth has been going up kind of steadily and slowly. It actually went up about 17 cents in August. And to give you a sense of that, you're like, well, Riley, 17 cents. This is the average wage growth is $30.73 an hour, the average wage. 17 cents a month, if we extrapolate that, if we divide 30.73 divided by 30.56, last week's wage, take it to the power of 12 and subtract 1, we end up with a wage growth rate annualized of over 6%, indeed closing on 7%. And so that wage growth number, now that 6 or 7%, is enough to sustain potentially inflation in the long run. Whether or not that will be the case is yet to be concerned, but that is something that I'm watching in great detail as we approach the future, is our increase in wages. Because when you look at how Fed policy works and other things, on one hand, the Fed has a very low rate of raising rates anytime in the near future. On the other hand, sustained indicators that indicate potential for sustained inflation would mean the Federal Reserve would have to intervene and raise that discount rate, that overnight rate, to large banks. And what this does is it makes a lot of economic projects not worthwhile because the debt is expensive now. And so consequently, people don't invest in as many things, and it has the effect of reducing the monetary supply. Now, Albert says, how much is a worker shortage contributing to the 17-cent an hour rise? As it turns out, I would say quite a bit, but that's what you'd expect anyway, is that in an event where you're trying to fill positions with workers, you have to attract. There's a fair price for every job. Remember that, right? There is a job where, regardless of your position, and I say this of having worked as in myself in my college years as a janitor, and what else did I do? I was a baker. I worked in I worked in all kinds. Worked in UPS for a while. I worked in all these little hourly jobs. I worked for a retail store. I was a cashier. And I had all these other jobs when I was in college and trying to pay for these things. And normally, and the hard part is that I would do any of those jobs again if the wage was right. And we all, I think, have a number in our heads, no matter what the job. If you paid me $5 million, I would go back to being a baker or whatever it might be. There's always a price for anything. And to attract people and to attract employees, employers have to raise wages. Now, the question is where's wage growth happening? Now, this is the interesting thing about economics, because we know what drives spending power tends to be very, very rich people drive consumer spending. And because they have a disproportionate amount of wealth, and that disproportionate amount of wealth that buys stuff generates a lot of economic activity. This is happening heavily on the lower end of the spectrum, which is a good sign for people in poverty. For instance, wage increases are shown in economic research to have a benefit on reducing childhood poverty. And that's an interesting part as well. So I would say quite a bit. And I actually have a chart where we'll talk about that in just a little bit, Albert, to give you a sense of the size of this. Now, so on one hand, you have wage growth, which I'm watching. And on the other hand, this participation number we've talked about, this is the amount of people who are of working age in our economy, the percent of them that are actually part of the labor force, meaning they have a job or they're looking for a job. This number has been at 61.7% for the last 3 months, and it has been virtually unchanged for the last year. And the hard part about this is this number is where a lot of those missing jobs go. When the pandemic happened, we lost people in the economy, not because of a pandemic related fatality, but because we're losing people either to early retirement or they've dropped out of the labor force. And they might drop out of labor force if they have to take care of children or older people or anybody in their family members that need care. And consequently, when they have to do these things, they're going to have to drop out of labor force. And we want them to come back because there's a lot of open jobs. Now, on the other hand, this participation rate has remained incredibly steady. We hypothesize that maybe there's going to be a little bit of a jump as kids go back to school, and this data goes into September. I'm really looking at the October report for that. I would like to see these numbers go up just a little bit more, but it has been steady, and that's somewhat of a concern. We want to see when people are more this is kind of a double-edged sword, right? If people feel like they have enough money in their household, maybe one partner would like to stay home, but likewise, most of the time, the idea that we can help, we can enter the economy and contribute and build and earn for ourselves in an independent way is usually viewed as a strong signal of economic growth. And so that is something that we're watching. Now, the number of people who are not in the labor force, and who currently want a job declined by 835,000. That is interesting, isn't it? So Albert asked about labor shortages. We're seeing right now that people are, despite we have all-time high levels of job availability. Now, I know you guys are out there on Albert's list going, I've been looking for a job for some time, and I'll tell you, the job pickings aren't good. And that's perfectly fine. And I know it's hard. I know this is a relative and aggregate number, and I don't want to diminish anyone's personal experience. But the number of people who are not in the labor force who currently want a job went down over 800,000. This is the opposite direction that we want to go in this economy. And consequently, when unemployment falls, it's the amount of people who are active in the labor force who are looking for a job or are unemployed but looking for a job divided by the total labor force. And if you're not looking for a job, you're not counted in the labor force and you're not counted as unemployed. And so this number, this 5.2% number, is a little bit deceiving. And people who focus merely on that number, that U3 number, don't get the full picture of the labor market. So anyway, so this is where we are. So let's take a look at the sectors. So again, I got these from the Bureau of Labor Statistics. On the left-hand side, I know this is really tricky to read unless you have an incredibly high resolution monitor, but we have employment change by industry just for August 2021 on the left. And on the right, we have the 6-month change. So in the long run, things are going up and things look good. In the 6-month time period, the graph on the right, we saw an expansion in leisure and hospitality, back over 1.6 million jobs in the last 6 months added in that sector. Government up about 500,000. Education up about 300,000. Professional and business services up to 50. All of those are good numbers. In the last month, it is noisy, and it's noisy for a few reasons, and a lot of that has to do with COVID. And so in this case, professional business services led this juncture, as did education, transportation, manufacturing, and some other services. We lost jobs this month in government, retail, trade, and construction. And that's interesting. given the demand for housing and other aspects in construction, but also construction is partially, it's not just residential, it's also commercial. Commercial construction is not where we want it to be. And there's still a lot of uncertainty regarding the nature of modality, regarding how workforces work. And so consequently, there's a little bit of uncertainty there. Retail trade went down. Retail trade is also heavily based off of consumer sentiment, consumer expenditures, and often fall and rise depending on the fortunes of COVID. And this leads us to this next point, which is the COVID effect. And I got this, and I've been looking at this for a few months, but I had a good chart that was better, more aesthetically pleasing than the one I tried to design about the COVID effect with regards to COVID cases against non-farm payrolls. And so the thing is, and what's interesting to observe about this is when we have disappointing jobs reports, they almost always coincide with periods of higher COVID case counts, right? And so we knew that last winter when COVID was just spreading through the economy, we saw increases, even decreases in payrolls back to where they were before. In summer, people became more confident. In early summer, I should say, and then consequently, COVID cases dropped in the meantime before Delta variant took hold. And then we saw this sort of drop off in our COVID cases that also followed this inverse relationship. Payrolls shot up. Now that payrolls are exposed to heavy COVID cases, payrolls are also down. So the part about this is that this disappointing jobs report is most likely due to the cyclical nature and temporal nature of the COVID increase. And so the big question that we have here is this going to continue? And this is, we don't know really. We don't know if the next variant will be in some respects vaccine resistant, or we don't know what's going to happen. The good news about the Delta variant, and on the right-hand side from Worldometer, I grabbed the 7-day moving average chart for California in cases per day. This mirrors a lot of the country. It's not as clear in California, but it is the same in the rest of the country as well in various states, no matter how you look at it. We saw sort of this massive influx in December and January of COVID cases, a massive drop off towards early summer. And as the Delta variant hit, we saw this increase, but it's also been leveling off. And this is promising because when we think about how we economically forecast, and now that we know that a lot of people are vaccinated, a lot of people have gotten the shot, and now the impact of even this variant is muted relative to previous variants. If this continues to kind of level off in this fashion, at least in the short term, this bodes well economically as we approach the holiday season. And this is something to watch. Now, again, we don't know, is it something, is the Mu variant or something like that Albert was talking about, the next variant, before we quickly run out of Greek letters and they start numbering things cryptically. What's going to happen? And the hard part is we don't know, but I would venture to guess that if we are crossing this pathway, if this is modelable and we're going to start seeing reductions in the annual caseloads as Delta has spread through and kind of hopefully will burn itself out in some way like the other variants, then we'll see continued economic growth and payroll growth as we approach December. There's not enough data to say whether or not there's nothing to say that we can't have another big jump in December with a new variant, or likewise, but I'm optimistic that October, November might be okay. Yes, Albert, Tammy on Facebook. Albert is copying a Facebook message, and while we ask, I like it. She writes, thanks, Tammy. Oh, there we go. It doesn't help that SF, San Francisco, and other airports in crowd events don't require proof of vaccination. Now, this is really interesting too, and you have a good point about this, is that in many places with, say, Pfizer's FDA approval, a lot of businesses have become more comfortable. Many universities, many private businesses have become more comfortable requiring employees to be vaccinated, as well as showing proof of vaccination, and then double checking that with other regards. And speaking to somebody who's traveling the West Coast, a friend of mine who's traveling the West Coast at a lot of different festivals and other things this weekend, and the weekends throughout September. Most of those events, because I was asking just along those lines, are starting to require some sort of proof of vaccination, et cetera, et cetera. These crowd events, I think you're going to see more of this in the sense that you become more, and I think you're going to see more of these, more of these restrictions involving the need to be vaccinated, which I think will also encourage people to be vaccinated from an economic standpoint, but within the certain bounds and certain limits that are permitted by them. And I don't want to step on too many toes, but I think that this actually, the tendency is to require it more than require it less. And so I think this might help this trajectory downward. I like SFO and when we no one likes the airport. Let me rephrase that. But I like that you mentioned that, because we're going to talk about that. Yes, she said, I attended a concert last night I attended a concert last night that required either a negative test within 72 hours or showing your vaccine card. They also accepted photos of your CDC vaccine card. Very good. And this is exactly, I think we're going to see this more often. And as a public policy standpoint, this represents sort of a tendency. There was some uncertainty. Speaking of this, I work at a university. The university was uncertain what they were going to do about it. They took a rather firm stance and required both staff, faculty, and students to be vaccinated. And so far it has been successful in that regard. And consequently, it does help people regain confidence in workplaces and economic activity. And so this is a really, really interesting point. And I see more tendency of this public policy. I see more economic consequences for people who might not be vaccinated in the future. That's a really good question. Really good point, actually. Thank you for sharing, actually. That's really good. And we're going to talk a little bit more about airports in a second. So COVID's a big deal here, but the idea is when COVID goes up, payrolls go down. When payrolls go up, or when COVID goes down, payrolls go up. I'm hoping if we continue to cross this and we get a little bit more leverage, we might not see good payrolls in September, but maybe October. So when we do the early November report, it'll be good. Now, Albert asked previously, and to get to this question as well, if COVID doesn't go away, and it doesn't seem like it will, how will these policies evolve and how will the economy adjust? So that is the $64,000 question, which is also what your monthly rent is. But $64,000 is you're like, I wish that's 2 bedrooms, right? One thing about public policy questions around COVID and how we can adjust to this is that, so let me phrase this thoughtfully. I think it is on the onus of our public policy producers, or public policy is the onus of the government, it's the onus of these, to have clear public policy goals with regards to what we want to do with COVID. 50 square foot closet in San Francisco. That sounds pretty fun. That sounds good. Does it have coat racks already, or does it have hangers already, or is it mainly just? Rents are expensive. But to answer this question, we have to make a decision as to what we want COVID to be, to make policy that's effective around it. Right now, we're waffling between the question of, do we want to eliminate COVID? And this is the hard thing, because we don't know the answer to it. It's not like we're waffling intentionally. We're waffling because of uncertainty. Do we wish to eliminate COVID? Or do we wish to produce enough or make it manageable within the economic constraints of society? And within that bounds, what do you think? And both of those have different answers depending on which you believe. So if you're wishing to eliminate the virus, you're looking at more severe economic sanctions and restrictions. If you're looking to minimize its effects, you have different public policy initiatives to encourage vaccinations, keep things open, but within certain effects, mask wearing, et cetera, et cetera. And it is challenging because in our current policy dilemma, and I'm not speaking as a policy expert, I'm speaking as an economist, we have the avenues by which we can increase economic sanctions in response to additional variants are lower than where they were back in March. There's a certain percentage of people reject the concept of any economic sanction whatsoever. A certain percentage of people accepted it and then lost their jobs or something and they don't like it. And then we also have people who might have been vaccinated and they got vaccinated for the purpose of engaging or going out in public and doing things, and they're averse to sort of additional economic sanctions. I'm trying to follow this in a decent way because this is the trickiest question. Is there an avenue for our society in general, not just California or the United States or different parts of the country or whatever happens, to meaningfully exert similar economic sanctions like we had back in March of 2020? And that's a very tough question to ask. I think if you ask parents of kids in schools, you have a variety of opinions. Some argue for the safety of their children. Some argue that they have to go to work and the kids need to be in school. It is fraught in every sense of the word. But we need to be clear about what our public policy objective is. And I think that you're going to see, my hope is in the next 3 months, some alignment on this effect, where we decide and say, listen, this is going to be something that we live with in some respects based on these variants or based on scientific progress and a relative amount of economic sanctions, perhaps we can eliminate it. And that's the question. And so I leave it to my health experts in the audience, as well as other people involved. But I will say both of them have economic consequences. And they're both interesting to follow, but both can be adapted to in different ways. Now, raining cats and jobs. Albert's question about jobs. Do we have a job shortage? Oh, goodness, we have a job shortage. So the total job openings, and this is from Fred, my favorite website of sorts. I have a t-shirt in Fred. I drove through, I was in St. Louis. I was in Kansas City in St. Louis, actually. And I drove by where the statistics are made back this summer, and it was just the greatest field trip of my life. And it was terrible for my family, but really good for me. The Federal Reserve Economic Database tracks a bunch of things. One of them is the total non-farm job openings. And if we go back since the year 2000, what we're looking at is the levels we're seeing now of openings above 10 million job openings across the country is the highest we've ever seen. They're enough to encapsulate and eliminate unemployment, but they're enough to potentially get people out of retirement or within the workforce to actually take these jobs. Now, this is an interesting question because if we talk about this, we lead to a couple of different perspectives on this. Extended job openings for a long period of time were happening prior to the pandemic in 2020. We had a lot of job openings. Why do these job openings exist and why aren't they being filled? Again, the pandemic didn't create a new economy necessarily in itself. Prior to the pandemic, we were still struggling to fill service sector jobs and we were still struggling to fill a lot of lower paying jobs. A lot of those have different reasons with them. We saw a tendency in the culture and right now it depends on, is the culture of teenage employment. Now teenagers have so much work to do to go above and beyond to get into colleges and to get scholarships and to sort of advance their careers. Many teenagers are out of the workforce. They don't work in the ways that they might have even 20 years ago. And then you have on the other end, a lack of desirability for these jobs. And so there are two solutions here, is that the employers themselves might be offering very low wages that people won't accept for this type of work, which leads to itself two solutions. Number one is that they have to raise wages for employees, and we're seeing a little bit of that right now. And the two is they have to look for alternative means to do these things, which encourages things like automation. It encourages non-employment robotics, those other things. And I'm not saying just merely like the Tesla robot that's being worked on, but I mean other things that you have out there like automation and principles and as well as a lot of service and manufacturing sector jobs have already gone that way, but it is something that to consider. And Albert asks, so what would you consider the reason why there's so many openings? Is it because people on unemployment are not wanting to come off, as some might say? So this is really interesting. So this is always the evidence. It was in this has been in papers all across the country involving this idea, this notion that people are on unemployment benefits sort of sitting around going, I don't need to work. And as if we can question the viability of this or not. And I'm certain there's somebody out there, and I'm not saying there aren't people who are doing that, who are like, I'd rather just get unemployment benefits. Right now, we have data from states after state. We started first with Missouri. We started first with a bunch of other states that also removed their unemployment benefits early. And when they did so, they did not see a meaningful increase in the number of jobs listed. They did not see those jobs listed. And that also goes along with data from the University of Chicago in a study they went from February of this year, which basically showed the same thing. When you pay people higher than typical unemployment benefits, people still look for jobs most of the time. And it doesn't seem to have a meaningful effect on whether they accept them. And so if you're waiting for it, and this is the hard part, and you can ask about human nature, I'm just expressing what the data shows, or why people are this way, or why people might not be taking these jobs. The job market's very competitive right now. There's a lot of openings available, and that's leverage that you can use to your benefit when looking for potential employers. Right now, and employers know it too, employees know it, I should say, because right now a study came out that said 2/3 of employees in a recent survey suggested they would be interested or potentially be interested in looking for a new job in the next year. That's a huge number. And consequently, people will switch around and do this. And I also think here, what's greater than this and underlying this question of this, and so think about everything else from a $30,000 foot view, the price of rent, the price of houses, the price of dreams. And also we have a population that is in itself more educated now than it was ever before. And consequently, filling these jobs in this way, it is very hard to find people to do the sort of labor intensive grinding work that a lot of the service sector jobs that are open are. And so you're in a situation where the jobs themselves match, and there's, to put it lightly, every time there is an economic recession, there is a tendency to speed up economic change that has been coming over the last decade or 2 decades or whatever, in a gradual way. Employers are forced to adapt. Job markets are forced to adapt. This means employees take on different skills and acquire new tasks. Many of them did so. And then at the same time, it means that employers themselves have to adjust to differing labor conditions. So what are these open roles, skills, experiences, or personality should someone have to get if they're out of work? So what are these open roles? So this is a good question. And so right now, this is really interesting. So you're out of work right now, looking at the 10 million plus, and this is a shout out to you. You're on Albert's list, and you're looking at this data, and I'm saying, look at all the jobs that are out there, and you're struggling. You're going and you're putting your resumes in, and you're not getting responses, you're not getting feedback, you're not getting directions from the people that or from businesses that might want to hire you. And so you look at this, it's almost insulting, right? You're like, how can I do this? Riley, why do you insult me with these things? Where we're seeing the job openings are, and this is, there's service sector jobs, there are retail jobs, they're across the board. If you've walked into a lot of service sector jobs that pay towards the minimum wage, they have an incredibly difficult time maintaining and keeping employees right now, period. You're seeing that across service roles in restaurants, fast food chains, places like Walmart are struggling to keep employees in a meaningful way. And in many ways, they were struggling beforehand, but now there is choice. Employees have the choice to move between different places. And this also is forcing a structural change. So you talk about personality and experience and skills. Right now, this is heavily driven by open service sector jobs, and then to a certain lesser extent to higher educated jobs as well, but just not to the same levels. And so in the same way that you look at this and you say, you might have worked at Walmart before, maybe you work at Walmart now, and you're saying, do I want to continue working here or do I not want to continue working here? Why would I do this task day in and day out for $10 an hour and not afford to live anywhere and have to commute from Chico every morning to go to this thing? And then you end up with the alternative is that you have you could do a job in an office that might pay 15, another job that pays 22, and then you have a job that pays $25 an hour. The people, the employees who are working hard, changing wages and building their skills are getting a lot of different jobs. And the hard part is the service sector jobs are just not there. The people aren't there to do them. What's exacerbating this as well, and this is flew under a lot of radar in a lot of places. We also had, right before the pandemic, of course, in the last administration, we had sort of a curbing of immigration, curbing a lot of the immigrant jobs that immigrants would fulfill, and a lot of these roles were eliminated, and this helped exacerbate some of these labor shortages. So if we go drill down to San Francisco now, just go down here, and we talk always about kind of the local Bureau of Labor Statistics data. Again, when you go down to local data, they don't release, they're always a month behind the regular data. So our most recent data now is July. But I want to say a couple of things. Remember that July was a really good jobs report. We had almost 1 million jobs added, and this also showed in San Francisco as well. So the labor force went up. Employment went up and the unemployment rate dropped to 5.8%. What I like about this a lot, you added about 2,000 more information jobs on top of the 3,000 jobs you added in June. And this is really good. This is very promising for Silicon Valley. So against the grain of our overall argument, looking at the service sector and looking at the lack of jobs there. And I think the lack of jobs in the service sector is keeping leisure and hospitality employment still down. That went up 8,000, but it also resulted in some interesting aspects, like service jobs were up 3,000. We had an increase in basically every sector, with the exception of government, which dropped about 20,000. I don't have a good explanation for that, actually, in the sense why government employment dropped so precipitously in July. I believed I was waiting for everybody's joining recall campaigns. I don't know. But it's a very good question. And so the rest of it in general has gone up, and we're seeing more employees out there in lower unemployment rates. More people are coming back into the labor force in the San Francisco area. That is a robust demonstration of the strength of the job market. Ooh, I've seen poll worker jobs come through. Yeah. Poll worker job requests come through. That's true. I know. September, what a month for a recall election. We'll talk a little bit about this. Albert asked me to do a little bit on this today, but there isn't a lot of good data on this. I'm actually interested to see how the recall election does. And then we'll talk about how different, when you go through different political views, the benefits and drawbacks of different economic theories, what works, what doesn't work, and trying to take it from at least a fairly neutral point of view. So let's talk about this. Let's break it down a little bit. Economic consensus. The good news is we had a terrible jobs report. That's the good news. But it was due to COVID. And we hope that it will go away. And the consensus is still good. So from my favorite of all consensus estimates, and this is taken from, oh gosh, we have a group of economists that come together and they guess what things are. And the best part about being in finance or economics, we make a lot of projections about what will happen. And most of the time we're terribly wrong. But in this particular case, so far, the third quarter results for 2021 are right about where we thought they would be for unemployment and a whole bunch of other economic data. And consequently, as we go towards 2022 and 2023, we see that growth in GDP gradually slowing down to 4% and 3%. Yes, that's right, Albert. In the long run, we're all dead. This is why. But the question is, do you want one of those golden caskets, or do you want one of those less golden ones? I don't know. Or do you want to be buried in a hardwood box? I asked my son, we live in the desert. So I asked my son, he's 7 years old, and he's gonna light me up in a Viking funeral, and we don't have any flowing waters. It'll just be in the arroyo. It'll be one of those things. So one of those things that we're looking at, though, when we think about GDP growth, we expect it will start going back down to normal. We expect inflation will tend downwards, but the best part about consensus is that in the long run, they're all wrong. And so one reason that economists are hesitant to issue forecasts in 2022 and 2023 is because there's so much uncertainty in the economic situation that it's not even possible. However, it still looks fairly good, and we are tracking approximately with where we should be. Now, when we think about this, let's break down a few things about why COVID is affecting the economy so badly this month. And let's do an example. Let's take a look at the Open Table Dining Index. And in this case, I have 3 charts here. They're very tough to read. 3 lines here. Let me see if I can, I should increase the size a little bit. It increases the actual physical size of the box. Let me go in here. Maybe I can screw around with the font. Anyway, but the blue line is the United States. The orange line is California and the gray line is San Francisco. So I downloaded OpenTable tracks the seated diner index, and it's a good proxy for how well restaurants are doing, especially the types of restaurants that you have to call ahead and sit at. So I'm like, what kind of restaurant is that? And so we can track sort of the economic recovery this way. So it doesn't provide an index in itself. So I kind of made one. What it does is produce the changes or relative percentages relative to where they were last year. And so I just turned that into an index starting at 100, where we're at 100% of where we were, and then 0, we're at 0% of where we were. And so I tracked this data from 2020 and I threw it in Excel and I screwed around with it. And so whether in the US, California, and San Francisco, initially at the beginning of March last year, everything dropped down to 0. And this is the beginning of the pandemic. You can see it right there. Different parts of the country opened up earlier than California. And San Francisco, of course, has some of the more restrictive restrictions across the country. And so consequently, the dining index for San Francisco last year never peaked really above 20% of where it should be. California as a whole did well. That tracked well with the United States. They reached about 60% before winter's COVID bane came through last year. And then this year they bounced up right again. And so we were on track May and June. We're looking at this. We're almost back to where we were before. Some weekends were so robust in California that we beat the where we were back before the pandemic. San Francisco reached about half, 50%. And since COVID started being a problem again, since July in a meaningful way, that's trailed off. That growth has basically stopped. That reduces the amount of retail hiring. It reduces the amount of, leisure and hospitality hiring as well. And so these two sectors have been driving economic growth and job growth. And so in the absence, the reason COVID's going up and we have such a flat jobs report is that people aren't going back to restaurants, which means that workers, even employers who might wish to pay a wage, are not going to do so because the market is not there yet. And so it's still struggling. So right now, even though California as a whole is still okay, San Francisco is still lagging quite behind, uniquely. And that's due to the restrictions, and due to restriction levels as well, and also people and their habits and their ability to go out and dine. I will say that city level data is more noisy than state level data. So while I vouch for it and I've used it all the time in these things, but the state data, California is tracking with roughly the rest of the country. We're seeing a slight decrease in overall dining, relatively speaking, on a week-to-week basis relative to where we were before the pandemic. This should be a little bit higher. We'd probably be about 10 to 15% higher in business for some of these restaurants. To give you a sense of that, the average restaurant has a profit margin of about 3 to 5%. And obviously economies of scale matter quite a bit, and that means hiring. So you have to, as you expand, you have to hire. Now let's think about this as well. So let's look at air travel. And we think about this, and not only, the tourists who walk around and that kind of stuff, but it's also a matter of looking at the way people view themselves in the respect of how confident they are about the economic situation. And so right now, if we look at daily travelers traveling through TSA checkpoints, 2021 is in yellow. We saw rapid growth February, March, April, May, June. It looked like we were going to reach 2019 levels and in July by the end of the year. That's since come down. Now, TSA travel is going down in fall because it always goes down in fall before the pandemic. The good news is charts are moving in the same way that they were before the pandemic. If it's real estate or if it's air travel, people are behaving in ways that are like the pandemic. 2020 was very, very odd. So we saw air travel peak and then it went up slowly. We never saw those levels come back. Now, the hard part is that missing piece, that missing 500,000 daily travelers who are passing through the TSA on a given year. That is still, we're still traveling. That's 20% of the below where we should be for this time of year. And consequently, that is hotels and leisure and hospitality. The Delta variant has an effect. It makes people less likely to travel. And that affects airlines, that affects tourism, that affects all those dollars that come in to these places. Now, when we think about these things, I want to talk about rents a little bit because this has been particularly fascinating. So across the country, rental rates. So we talked about housing last time, but let's talk about rents. And we talk about rents because not only that, although the average Roughly 66 or 66% or 2/3 of Americans own a home, or households own a home. In San Francisco, it's lower, about 50%. I wonder why. It's as if it's more expensive than the rest of the country. So across the country, rental rates are rising high, uniquely not in San Francisco, but we'll talk about why. Nationally, they're up 11% this year. Cities like Albuquerque are up 18%. Cities in the Central Valley are up significant. So homeownership is becoming expensive. So that's the first thing, right? House prices went up, and people often view renting and housing as complementary goods, and they view that they should move against one another. It's not that easy. Housing became very expensive. And so logically, does that mean that means that a lot of people were forced out of the market for prices, and so they had to find rents. And we also saw something happen at the beginning of the pandemic. Household size, or the number of households in the country, dropped. People moved back in with their parents. People, young adults particularly, moved in back in with their parents. They moved in into situations where they moved in with elders. People consolidated their households. Since that time, the greater economic growth and greater economic confidence led to this reversing itself. We have more households now across the country than we've ever had before. More people competing for the same level of housing stock means higher prices. Vacancies are at all-time lows in many places, about 3.8% on average across the country for apartments. Price growth is high, but it's slowing. The question is what's going to happen with construction. So vacancies prior to in the pandemic increased up to 7% of all apartments were open. Now it's dropped below 4%. And what happens is, as those vacancies drop, apartments can start charging more, and they're charging more because they know that your other choice is, do you want to buy a house if it costs $2 million, and you look around and you're like, no, not today, maybe tomorrow. And people are waiting for the market to change. Now, there's also a few parts about this that are interesting. Number one, people are there's something called, we call this the flight to the suburbs. We talked about this when we talked about the California exodus before. And it's often located to a few different areas. Now, across the country, apartments are becoming more expensive. In this chart of the country, darker colors indicate greater year-on-year price increases. Blue colors mean drops. Uniquely in the country, to the areas that we're seeing, rental price growth was down 6.9% in San Francisco, 1.9% and 2% in Berkeley and San Jose, respectively. Yet, if you go out to Citrus Heights near Sacramento, you have growth of about 27% year on year, 27% growth in rents, 25% growth in rents in Fresno. I joked about that 2 months ago. Why don't you move to Fresno? Apparently everybody did. Everybody moved to Fresno. Now rents are 25% more expensive, and the commute is still terrible. So please don't commute from Fresno. So one of those problems, and this is the hard part about this, when we went back to 2008, we had a single family housing crisis. After the recession was over, multifamily housing picked up and growth increased. Apartments were more common after 2008, 2009, 2010. Construction came in, they built a lot of apartments, and consequently, this helped keep rents low as the housing market came back online slowly. The problem is now we're not sure what construction is going to do. So in this case, people are demanding single family homes. That puts pressure on construction to focus on building single family homes and not multifamily units, which can relieve the rental crisis. Now, the benefit is if you live in places like San Francisco that are actually suffering more from a loss of people who wish to move out to cheaper areas or greener pastures in the country, or that dream apartment that you've always wanted in Hayward or Castro Valley, or somewhere else that you want to go to. This is sort of the dynamic that we're seeing. And consequently, the inner cities are seeing sort of this carve out in some areas. So whether it's Minneapolis or whether it's San Francisco or whether it's Washington, we're seeing some questions about rental rates in these highly priced areas. Now, on the other end of this, is this surprising to anyone? Anyone have any impacts or questions about this that I missed? All right. Never hesitate to ask. There's no such thing as a dumb question, only a dumb answer for me. So we're seeing this price. And so the hard part is about this. If you're waiting on this, if you're waiting on the question of so this is all pandemic related, and it's pandemic related because we saw a shock of the pandemic followed by a rapid change in consumer habits. And there is nothing on the immediate horizon that will stop this sort of charge into higher rents in a lot of these areas, apart from a massive increase in new units or construction or something else to help drive down the price of houses. It's just not there yet. And it's going to work through its system, and it's likely. And the hard part is I cannot say when it's going to stop. It's likely that the next time we'll see sort of a shock to our market in this way is when the Fed ultimately chooses to raise rates. And as they raise rates, that creates different dynamics. It obviously reduces the purchasing power of an individual to buy a house. That could have a cap on some real estate prices that we're hoping will happen where we have affordability issues. And that in turn can help, in some respects, take sort of the heat off of the rental market. And those of you who picked up The Economist last week, you may have seen The Economist had a 2-page article on San Francisco. So, and this is the point being, is that if we look at job losses recovered since pre-pandemic peak, and this is the city itself relative to the aggregate metropolitan area, because the data I have from the Bureau of Labor Statistics, I mean, we're still not there yet. But we look at the job losses recovered, and San Francisco is lagging behind most other large cities across the country. Some cities, there's more people in Salt Lake City working now than back before the pandemic. The United States as a whole recovered about 75% from their job losses, slightly lower than 50% for San Francisco. This is a really good question. So Charles, that is a great question. Is it accurate to say the government is feeling the home crisis by keeping interest rates low? Yes. The government, by keeping interest rates low. So of course, so this is a really interesting point. And so Charles asks, so what the Federal Reserve does is it's an independent agency, and it has 12 different districts from across the country. And each of these districts are represented by different Fed chairs, and they come together and they vote on rate increases or decreases. And they vote on one rate specifically, something called the discount rate, which is overnight lending to large banks. But the thing is, this rate is so important that if banks get cheap capital, then they pass it off to smaller banks, and then mortgage rates follow on a 10-year bond. And consequently, this helps keep rates low. What really is an interesting sort of prickle in the housing market side, Charles, is that there's also what the Fed's been doing as part of its quantitative easing price policy is that it buys a lot of mortgage-backed securities. It buys tons of mortgage-backed securities. And so mortgage-backed securities, of course, having been a former banker myself in a bank that ultimately went under due to mortgage-backed securities, I was not responsible for that. I was in the commercial side. So, but the mortgage-backed securities were a huge factor in this. And what happened is when you package a lot of loans together, you sell them to other lenders, et cetera, et cetera. And what this does is it helps create and encourage demand for these securities in the marketplace. And that in itself, by encouraging mortgages, continues to make the market more competitive, continues to help keep mortgage rates at historic lows. And that, of course, means higher prices. And so there's a pressure on the Fed to kind of ease off their buying of these securities so that they don't exacerbate the growth of the market more than they've already done, because this is what we do during a recession, right? And we're not in a recession anymore. We're in an economic growth period, and the real estate market is flying. And the hard part about real estate is you either own it right now or you don't. And if you don't, you're watching prices go by every day. And you're saying, when will I ever be able to afford a house or any place for my family or even to build equity? For most Americans, the majority of Americans, the greatest source of their wealth comes from the ownership of a house. And so it becomes a very, very important factor. And so the Fed's going to have to back off. And what I think is going to happen is the Fed will ease quantitative easing, particularly around these areas. The Fed has expanded their balance sheet to many, many trillions of dollars. And consequently, as they start easing off on this, and as they potentially look at the inflation questions in 1 or 2 years ahead of time, or less, depending on the nature of the next economic forecast, they'll start raising those short-term rates. That will help lower increased mortgage rates. And in the long run, then we can look potentially towards a little bit of a reduction in some of these incredibly high house price growth. Money printer, go burr, burr. I love that sound. I don't make the right sound. It's like burr. It's not freezing. It's burr. You know, it's the sound of a money printer. And I never really adequately describe it. So thank you, Albert. It looks better in memes. So anyway, so you saw this as well, the Economist's take on San Francisco. And, and they were placing it mainly on the governance of the city itself. But there's also all these fundamental issues involving the questions of high rents, zoning restrictions, other things as well that keep it very difficult to maintain. Now, the last topic for today, and I tried to finish within an hour because I know everybody's on Labor Day and I'm just almost there, is the other factor, the other COVID factor that does hit close to home for every single person, whether we acknowledge it or not. It's not just Silicon Valley, it's every consumer across the country, is the global silicon chip shortage. Now, I believed, and I gave this earlier this year, that we would see a gradual easing of this process as time went on. As it turns out, so the thing about international supply chains is that we're heavily reliant on sort of if you think about where products are made and then ultimately where they get sold and then put into other products and then sold again, we can connect all those dots together into a supply chain. And making silicon chips aren't everything now, and they're often made, and the greatest source of them, and I know I have an old chart here that looks at Asia Pacific, is actually the Asia Pacific region, making about over 60% of them, especially now. Used to be primarily China, now it's also Southeast Asia. And they're heavily hit right now. Southeast Asian factories have been forced to close due to COVID. This has exacerbated the global chip shortage. GM and Ford came out last week and said, basically, we have to halt production because the silicon chips which are needed in our vehicles, we cannot get enough of them. Electronics are becoming more expensive for them, and consequently, they can't get them. They're looking at this extending. It was supposed to be resolved by this year, 2022, 2023. High vehicle prices are now leading to fewer sales. And also what we're seeing is that the vehicles that are out there, including your used vehicles, including whatever jalopy it is that Riley drives, is also going to be, are also commanding higher than average prices. And so the problem is this is now spreading to other places. It's become more dire. And this is another thing as well. We usually thought about shortages in the sense of, like, for instance, we thought about, so graphics cards with relate to cryptocurrency mining. People are heavily concerned about shortages in that area and rising prices because of that. Chips are in so many things and have so many purposes and have so many things to do these things. It's become incredibly pricey to even build out your own PC. And these supplies are affecting, and now you have, these manufacturers of consumer products like Apple saying, well, we're going to, if we release when we release our new model and we have to make sure we have enough silicon chips, they're issuing all these caveats because they're now at the whim of these supply chains and they're taking gambles on this as well. And it's to the benefit of firms domestically like Intel, that have a sort of a deep national US supply chain. But this is going to take a longer time than expected to fix. And there's no easy answers here. And I expect that even if COVID went away tomorrow, we would be many months out from fixing these supply chain issues. It is so much harder to build production back after cutting it than it is to actually cut it. And so that's where we are right now. So that's where I see the primary effects. Now, going forward, looking at COVID, if we expect this will come down again, my hope optimistically is that we can get around this, get clear public policy issuances, and then the next year, hopefully, fingers crossed, we can get a lot of these supply chain issues resolved and continue humming along with the economy. Hopefully, the Fed will stop easing off on the mortgage-backed security payments, which help reduce the growth in real estate prices. And a lot of these rental prices will be met with additional construction, helping build out units and multifamily homes to help make it more affordable. That's my hope. We will see what happens. Because if anything's cool about economics, it's that everything is unpredictable. And so that's what we got. Anybody have any questions about anything? Silence. Sorry, I went casual today. It's Labor Day. It's the last day I can wear blue golf shirts. Oh my gosh, thank you so much, Joanna. Oh gosh, I'm so grateful. And if you have any questions, that's such a nice thing to say. Thank you so much, Joanna. It's such a nice thing to say. My favorite attendee, besides Albert. Anyone else have anything they want me to ask? There's no such thing as a dumb question, I promise. I'm always interested in what you have to say and what you think. All right. Ooh, Albert says, any predictions for the stock market the rest of the year? We are at peak. We have been at peak for a while. The stock market's going to do one thing. So here's the cool thing about stocks is that stocks are based off of the future performance of a company. And so things like, and we think about things, looking at things today and in real time. So there's an instinct for us to say the economy is doing well, so therefore stocks will do well. Really, it's incorporating all those future profits between now and the end of time, consolidated them into a present value, and then divided by the number of shares, boom, there's a stock price. And so the stock prices go up and down because the stock prices have gone up catastrophically, tremendously, because we have incredibly low interest rates. We have investors looking for places to put money that yields something that's not zero. And so they put them in the stock market. And also we have the benefit of incorporating all of that economic growth and everything that we've seen that's already in the stock market right now. I don't see a lot of economic activity to drive, like a surprise to drive the stocks incredibly higher by like 20 or 30% like we've seen lately. But there is some caveats. If we can maintain lower interest rates for a longer amount of time, that means that the stock market will continue. Again, that caveat, that tipping point is when the Fed chooses to raise rates. If the Fed raises rates, then the stock market often goes down because investors start making decisions and they say, I can get this yield in stocks for this level of risk. Maybe I can start putting it back into safer items to get a steady yield. Or I might, if the Fed raises rates too quickly, then you get something like an inverted yield curve, and then that can predict a recession, and that will basically inform the stock market, hey, it's time to crash. And so that's something to watch. So watch rate increases specifically on that. So the stock market's going to, the stock market has some avenues to go up or down marginally in the next couple of years. But when rates start increasing, expect that those prices become a little bit more fairly weighted. Let me show you something as well. If you're really interested in this, one of the cool ways we can track stock prices relative to their baseline values is using something called the price to earnings ratio. And to give you a sense of this, and I'll share my screen here really quick, just so you can see it. This is from multiple. This is the S&P 500 price to earnings ratio. Maybe I should actually use the Shiller PE ratio. That's a little bit more normalized, but it shows you how expensive the stock market is relative to where it is. Price to earnings is the price of the stock itself divided by the earnings per share, or how much money the company actually makes. When it's high, we say it's overvalued. And when it's low, we say the market's undervalued. And so look at this. So this is tracking it since the 1870s. In 1929, we had Black Tuesday, right in the middle of preceding the Great Depression. We crashed and it went down. And then, of course, we had the tech bubble in 2000, back when you had companies that were, you remember the tech bubble, or maybe you don't remember the tech bubble, but you know about the tech bubble. So we had, massive amounts of companies that had high price valuations, but very little earnings. People all knew the internet was important. They didn't know which parts of the internet were actually going to make money. And so consequently, investors threw their money in anything that's an internet on it, and it went up to the highest value ever. We are at the second highest value of the market, meaning that the average price for a stock in the S&P 500 is now almost 40 times above what it actually earns. Over the long term, the average is 20. So I'm not going to tell you to predict the market based on that, but I will say, please be cautious with your investing on this as well. You want me to predict? Oh, great. Albert wants me to predict crypto as well. No. Crypto is fun to watch. It is fun to hold, but it is not yet ready for prime time prediction. But we're going to figure out a measure like this. And when we have enough data, my hope is we have something like a measure. I won't be price to earnings because the way that Bitcoin prices work, but maybe we can work on some of the existing indexes out there that looked at cryptocurrency over and under valuation. So that was kind of cool. That's a little side note for you all. So again, this is really expensive. The market is really, really expensive relative to where it is over the long term. So keep that in mind as you make your investment decisions. And always speak with a financial advisor. Oh, yes, Albert, weren't you listening, Albert? 39 is 39.17. Yes, hold on, Albert, hold on. So the long-term average is 20. I should have explained this better. It's on me. I'm just kidding, Albert. You're awesome. So 39.7 is incredibly high. Higher numbers mean overvalued. Lower numbers mean undervalued. In the 80s, interest rates were really high, which meant that a lot of people could buy things like bonds or put their money in savings accounts and still get really good interest rates. Few people wanted to invest in the risk of the stock market. And so price to earnings ratios were very low. When interest rates are low, And demand, on the other hand, stock prices go up. And we've seen this sort of low interest rate period followed by sort of these highest ever levels in our stock market values. But what we really look at is that this number of 39 is almost double sort of the long-term 20 average that we've seen on price to earnings. It doesn't mean that tomorrow we expect a crash where the market's going to drop 50%. It's possible. It's always possible. And it'll be a fun story if it does crash. And Riley was, October is coming. But it's going to be interesting. This is due for some type of correction. Unless profits come up significantly to match this number in a meaningful way across these large firms, I don't see a mechanism for that happening. It's going to be a tricky road ahead to expand the market much further. But again, we're going to see what happens. So take a look at this. Oh, goodness. That's a good question. Anyone else have anything? These are good questions, Albert. I'm sorry for giving you a hard time. It does not diminish my utter respect for you and how awesome you are at including me and being part of this list. It's not Riley's list. Anyone else have anything?
Well, if not, we can send everyone into their Labor Day weekends.
Yes.
Any just final thoughts? I mean, it seems like some states are now seeing their Delta variant infections drop, while others are starting to come up, and so we could still be stuck in this for a while. And so, what are your final insights for job seekers and for those who are prognosticating the economy as we look forward here to the next month with our recall elections and anything else?
So the good news is, so the relationship between, thank you, Albert, of course, and I'm so grateful for those of you who stayed on all the time, and I'm really grateful for those of you out there on Facebook, and thank you so much for taking part of this today. It's an honor to speak to you all. But some advice I have going forward is take a look at the COVID numbers. And this is the interesting part about this. The relationship that we've been playing with for a while is pretty clear. Higher COVID cases mean less hiring. Lower COVID cases mean more hiring. And so if you're looking at a question of when to make the push towards either another job or to kind of ensure that your job is in a position where you're reaching the largest number of firms, wait for Delta to be over, wait for Delta to go away, as it will go away in a meaningful way. We might have another Delta variant, but in that space of time, as people restore and get confidence and start moving and going out and doing things, that could be an opportune time to make a move into a different place. So keep an eye on the market, keep an eye on the COVID, and keep an eye on those jobs, and keep up the good work out there, and stay, hopefully, do whatever it takes on your end. Keep building your skills, and keep doing great things out there.
Well, wonderful. Thank you again for joining us, and we appreciate those insights as we do every single month. And thank you all for all of those who are here on a Friday night before Labor Day, getting your economic nerd on. We really appreciate that. So if you enjoyed this event, we'll be doing this event next month where we're going to discuss the September jobs report and any ongoing fallout from the recall, should there be any, this upcoming September 14th. If you've got any additional ideas for what to discuss, please let us know. Finally, we have also other upcoming events of interest. You can take a look at our Eventbrite page here that I just linked. This month, we're going to be kicking off our job search bootcamp, deep diving into LinkedIn and exploring how you can master your performance review. Take a look, let us know if you like what you see, and we'll go from there. Between now and then, have a wonderful, fantastic weekend, and we'll see you all next month. Bye, everybody.